For another session this week. It is Selfwealth Live, the Selfwealth by Syfe Live. It's the technical analysis edition here with myself, Roger. I work for Selfwealth, obviously, and then Jason McIntosh, whose business is Motion Trader. Hi, Jace. How are you this week?
Hey, Rog, I'm good. Glad to be back for another show. It should be pretty interesting. I think plenty of things to talk about. Some good view of stocks, I'm sure, to have a look at later on. So all in all, pretty good.
Yeah, for sure. I'm a little bit frazzled, to be honest, because we just had the King's birthday holiday once again, weekend, and it wasn't the best of weather down here in Victoria and Melbourne. Anywhere you went, it doesn't matter where, you had to stay in the hotel room. So I was away for the weekend, and now coming back on the Tuesday, starting on a Tuesday, it throws me a little bit, right? But that's okay. We'll get into it because I was looking. I literally only didn't look at the markets at all from Friday to Saturday, other than my portfolio, and it's still in check. Funnily enough, but it's very thinly traded over the last over Friday and Monday anyway, right? Very tight, small tight range, so not a lot of movement there, but it's still positive in my eyes, which is good to see. Good to see you, right? So, all right. So let's get going. This week, as per usual, we are going to go through the main markets, Australia, US, and Hong Kong that we offer here at Selfwealth. And then as a viewer question there, we're going to talk a little bit about position sizing, right? And then we're also going to go through your tickers. So please feel free to send through your tickers. As soon as you have them. There will be a cutoff point. Obviously, we're getting a lot of tickers of late, but hopefully we get through as many as we can today. But before that happens, Jace, let's have a look at our disclaimer, please. Thank you.
Yeah, so just quickly, everything we do today is general commentary only. Nothing is personal advice, and this graphic here goes through all that. I'm also not part of Selfwealth/Syfe. I'm Motion Trader. That's my business. You see my details up the top with licensing, and beneath there you'll see the Selfwealth licensing, etc. in there. So yeah, everything general commentary only.
And if you are here, shoot us a hello, right? Because for some reason, it just doesn't seem like as many people on the other side as usual. Maybe they're still on holiday. I don't know. But if you are here and you're listening, please shoot us a hello in the message box and shoot us your tickers. All right, let's get going. Let's have a look at the Australian market to start off with. Like I said, trading in a very tight range at the moment.
Yeah, so starting off with the ASX 200, and Rog, this relentless rally continues. So not only did we see one of the great panic sell-offs, we've also been witnessing one of the biggest scrambles back into the market, and now here we are with prices less than 1% from a new all-time high. And we've seen this strength playing out across the ASX. So it hasn't just been a big cap rally. The mid caps have been rallying, the small caps. It's been a broad-based advance. So I think that's positive when you get broad participation. And it's positive because broad participation typically is associated with a healthy market. It's when you see gains that are attributed to a narrow group of stocks, like it might be a tech rally or a big cap rally, or it's narrow. That's when I'd get concerned. But that's not the case at this point in time. Another positive is that the moving averages are now back in a positive position, and that is with the 50-day being the red line above the 100-day in blue. And prices are becoming more established above the moving averages. So the ASX 200, it's now closed above the 50-day moving average. So this red line, it's closed above the 50-day for the last 31 trading days in a row. So that's a clear indication for me that the underlying momentum, there's been a shift. There's really been a shift in that underlying momentum. And every bullish period that we look at over time, they're all associated with lengthy stretches above the 50 and 100-day moving averages, and we're starting to see that now. So from this perspective, I'm happy to be long stocks, and that's something we've been discussing over the last 6 weeks now. We started talking about like that gradual re-entry process. But then it brings in the question of like, do I want to be an aggressive buyer at current levels? And my answer to that would be no, I don't want to be aggressively buying the market. As I said, it's been a gradual push into the market over a number of weeks rather than an aggressive tipping point where it's just all in. And the reason for that is, well, over the last, really, it's probably been the last maybe 3 or so weeks, we've been discussing the prospects of a pullback towards this 50-day moving average. And so far, prices have kept grinding high. We haven't had that pullback. We did get some sideways consolidation about 3 weeks ago, but prices never got close to coming back to this moving average. And so that raises the question, like, could prices just keep advancing and maybe we don't get a pullback anytime soon? And I think anything's possible. Of course, it's always a possibility. And if that happens, well, I'm long stock, so I get to I participate in any further upside. So that's all good. But I still believe the odds suggest that the near-term upside is probably limited with the all-time high so close and prices maintaining quite an elevated position above the 50-day moving average. So that means I'm being patient with adding new money to the market. Now I'll show you why I think this. So the ASX 200, it's about 20%. So from those lows, it's about 20% off the low. So that's an exceptional rally over a short period of time on its own. But the fact that it's got there without any meaningful pullbacks, well, that's actually a rarity. We don't see that often at all. I had a look back at some similar situations over the years, and I was showing members of my strategy session on Friday the other day. I'll go through and show the viewers today as well. I think it's really interesting. I was specifically looking for periods or instances where prices quickly rose from being below moving averages to being above moving averages, and there are a handful to look at over the last couple of decades. So let's just quickly go over and have a look at them. I'm going to use the All Ordinaries because I've got a longer data history for that than the ASX 200. So here's our current period. See in the blue shaded area, there's our 20% advance to date. Maybe it goes further. Time will tell. Now let's look at the previous ones though. So here's the first one to look at. This is from 2022. From below the averages to above, prices got stretched. They ran 15%. Then they came back to the 50-day moving average. Then we've got another couple of examples over here in 2016 and 2019. Again, you can see in both cases a 14 and a 16% advance from below the moving averages to above, and then prices came back to the 50-day moving average. Not quite in this example, but very close. But there was that pullback, getting stretched above the moving averages and then coming back. A couple more to show you. Here's a 15%er from 2013, below the averages to above, stayed elevated for a while, like we're seeing at the moment. It did stay elevated above those moving averages, then it came back and touched the 50-day. And I've got one more for you, and this was just leading into the GFC, where we go from below the moving averages to above. This is a 25% rally, so this was the largest in this series, even larger than the current one. And then invariably prices come back to that 50-day moving average. Now, I'm not suggesting that we've got another GFC in the makings. It's just a sequence we're looking at from below to above and the pullback. What happened next? Well, that's another matter. But that's the point. That's the point I'm making. These moves that go from below to above, they do come back. And when you're getting 15 to 25%, that's been the historic parameters where it becomes maximum stretched and then comes back. So bringing that back to present day, well, there we are. Like how this one will play out, time will tell. Coming back to the ASX 200, so no one knows when this rally is going to run out of steam. So what I'm doing, I think it's really all now about balancing risk. I'm happy to hold what's working. I'm happy to buy stocks that are breaking out of ranges or rallying off moving averages. But what I don't want to do is chase what's been running hard and that's due to the risk of a pullback, and that risk that we've just been looking at through those past times over the last 20 or so years. And as always, I've got my wide trailing stops in place to help see off any return to the 50-day moving average when that invariably does come.
Yeah, good point there, Jason. I think I might bring up an example later on of where I sort of chased, and maybe you can give me some pointers. But I actually broke my own rule in not waiting for a pullback, right? I sort of know the answer. But let's get on to the it might be good for you viewers to see as well. But let's get on to the US markets then.
Okay, so going over to the S&P 500, well, it's been an ongoing consolidation really over the last week or so. For most stocks at any rate, they've been consolidating, and this shouldn't come as a surprise when you consider the index has just had its strongest performance in May since 1990. So where's the start of May? So this is the start of May. This is where May started, and May finishes up around here. So that's the strongest performance in May since, as I say, 1990. So 20, what's that? Is that 35 years? So it's a long time between having its strongest period. So interesting when we think about that, because most people are probably familiar with the saying that goes, sell in May and go away. And it just goes to show, make your trading decisions off the price action, not off the calendar. It's, these little sayings that we hear in the markets, buy low, sell high, sell in May, go away. They all sound good to roll off the tongue, but what do they actually mean? And do they put you off doing what you should be doing? And often I think they do. They do throw you. So anyone who sold at the start of May, going off the calendar, has probably been maybe looking back with a bit of regret at the moment. So yeah, follow the price action, not the sayings or the calendar. So what's this price action telling us now? Well, prices have been generally, as I say, they've been generally traveling sideways for the last 3 weeks, although on this chart it looks like there's been a steady rise, and that's largely due to rallies in Nvidia and Microsoft, which are the two largest stocks. The broader market, I think they're the two largest stocks. Apple's in there somewhere, but they're up there. They're up there amongst the top bracket of stocks. The broader market's been more subdued, and I'll show you what I mean by that. Let's have a look at the S&P 500 on an equal weighted basis, and you can see now that rally, which had just taken prices up to a new high, is it's now pretty much a sideways rally. And the equal weight's really interesting, and I think it's useful to always keep an eye on because it ranks stocks equally from the biggest to the smallest. They all have the same ranking, so you get a better feel for the overall market rather than what Nvidia and Microsoft and Apple are doing, which tend to really pull the main or pull the S&P 500 in one direction or the other. And I think that overall, the price action we're seeing is positive. The signs are so far that these dips are being bought, which is, of course, what we want to see. You'll also notice that the pullback from the May high, it's been shallow. It's only come back to the 100-day moving average, and the 50 days just coming up beneath there. And I think that's important because it shows that the buyers are quick to buy the dips, and it's not the case of the sellers rushing in to sell the rally. It's interest in accumulating as prices come back, not a rush to dump as prices start going lower again. So this appears to be a market that I think buyers are looking for a way into as opposed to investors looking for a way out. And I think what that does, it sets up a positive backdrop going forward. You'll also see these moving averages continue to turn higher, close to crossing. They've already crossed on the S&P 500 and they're close to crossing on the equal weight. It looks like the cross will happen in the next few days, barring anything spectacular happening. That should be the next thing we see. Of course, yeah. So and that's positive because prices are above those moving averages as well. Now, just bringing it back to the S&P 500 to finish on this section. So what I'm doing here, I'm continuing to play this from the long side. There could be some more chop and consolidation, but the structure's positive where prices above moving averages. That's positive. and there's that interest in buying the pullbacks, not selling the rallies. The sort of stocks I'm interested in at the moment are ones which, as I said with the ASX 200, they're stocks rallying off moving averages or breaking high from consolidations. And I think it's a case of going with what's working and managing risk with those trailing stops, wide trailing stops that we always talk about.
Yeah, of course. All right, let's get on to the Hong Kong market. Thank you.
So coming over to the Hang Seng, and it's had a strong rally off the 50-day moving average. So I got the 50, got the 100. You can see prices came back to the 50, and they've quickly rebounded off there in the last the last week or so, and it's now closing in on the March high. I would have liked to have seen some more consolidation. We had that initial pullback. I thought maybe we would see some more consolidation along the moving average, but what we like to see isn't always what we see. The brief pullback, this brief pullback we've had from the May high, I don't know, Rog. I just don't think that's long enough to correct that rally from the April low. Overall, this looks like an encouraging structure. We've still got the rising moving averages. Prices are back above. They're moving higher. But I'd rather just watch this one for now, as prices are approaching the all-time high, and they haven't really had much of a pullback as yet. Not dissimilar to what we've been talking about in the ASX 200. Just the need for pauses, consolidations. I'm just not sure it stacks up as a great risk-reward entry point at current levels below a recent important high. And when you look at the Chinese market, this is another factor in that at the moment the Chinese market's not confirming that strength we're seeing in the Hang Seng, because the Chinese market is continuing to consolidate along its 50 and the 100-day moving average just beneath there. I think this is an interesting structure overall. When we step back and look at this, I think that this whole period from October through to current day, I think that's got the potential to be a launching pad for higher levels. I think the key though is just waiting for a breakout. The breakout point I'm looking at the moment, it's just these two peaks from May. Just keeping an eye on those. So for me, I think that a break above those May peaks, that would be would then have a cause to say, okay, we have a trigger for getting along the Chinese market. Would then have a series of early rising lows, would have a breakout, rising moving averages, and price, of course, above the moving averages. So one to watch at the moment. And I think if this market interests you, be ready to act if we do get a break above those recent peaks.
Yeah, if we go back to the Hong Kong market, that's nowhere near its all-time high, though, is it? At this point, it's still like compare that to the Australian US, where we're trading near all-time highs.
Jump to a weekly, and look, you can see it's a long way from all-time highs. Asian market, a lot of the Asian markets just haven't really, like there's the GFC peak. It's like you look at the US GFC peak and the market is way beyond. The Aussie market is beyond, but not way beyond. Whereas a Hang Seng is below the GFC peak and it's below the peak from 2018. And the same is true when you come over and you look at the Chinese market. The peak there was back in 2021. So these things, all these markets, they can do their own thing. There's broad correlations, but not everything's doing exactly the same thing at the same time. But I do think this is interesting. Like, is this all part of a rounding base in the Chinese market? So lower lows give way to rising lows. Now I'm looking, can we get this breakout above those May highs and start seeing upward momentum? It's I won't be surprised if the Chinese market's trading at an all-time high in the next I don't know, maybe it's the next couple of years. It's a market which is down and out, gets lots of bad press. That's often when major lows form, when there's disinterest, when it's people are generally negative towards it. I wouldn't write it off. It's one I think to be keep an interested eye on.
Yeah, I think so for sure. We've done a lot of I think it's around sentiment. Sometimes you got to really keep an eye out on sentiment as well. I know we do a lot of technical trading. We talk a lot of technical trading, right? But I've read a lot of comments, on our previous videos as well, and we talk about that argument between fundamental and technical once again. But if you can get ahead of the game a little bit with sentiment, that can really boost your technical trading, right? And I thought I had a bit of a sentimental play. I thought lithium was coming back a couple of weeks ago when it had a bit of a spike, Jace. But maybe you can point me out on my errors and show everyone else what happened with CXO. And in all honesty, I kind of knew I put this stock in one of my hit and hope portfolios and not in my motion trader portfolio, right? And I know the EMAs hadn't crossed at that time, but I just bought on the spike, and I thought sentiment around lithium was starting to come back, especially as well, along with these bigger electric car makers in China now, like BYD overtaking Tesla in sales and all that sort of stuff. I thought, all right, maybe lithium's going to make a comeback at this point, along with other resources, right? So, but maybe you can point out and tell me what you think about this one.
Yeah, it's well, I can see why you would have thought it was interesting and worthy of a go. Like if you're using 20, if you say you're using say 10 and 20-day moving averages, you would have had a moving average cross, and you got like a strong push above it. What we often talk about, I often talk about like, you get that initial push along above the moving averages. So let's just put it on. Let's just see what the 10 and 20 would have looked like. Yeah, so you get the spike higher. So then I often talk about, okay, let's see what the pullback looks like. Is there buying interest on the dip? So you get the initial pullback to the moving average, and so far that's consolidating nicely, but just start to give way a bit towards the start of June. I wouldn't say it's completely out of the game at the moment. It's we could still call this. You could still call this like a zigzag pullback to a market which is preparing to push higher. But it's like the tricky part is, where do you put a stop? Like if you buy the initial spike higher or the initial strong rally higher, you kind of you're kind of like looking at a stop which may be around 30% below. So it's a pretty wide sort of stop. And if you go for anything less, you risk the zigzag pullback or something just taking you out, and then the stock strengthens again. So look, there's certainly a play there. For me, I do like to get that pullback to the averages, the consolidation, and then the rally off the averages again. I'll just swing this back to the usual moving averages.
I bought this on the breakout based on some of the rules that you used to trade on, or you do, and I broke my rule in waiting for the pullback and then swing up, right? So anyway, just what happens.
Yeah, other thing I would have looked at, keep an eye on these lithium stocks. This lithium ETF. There's two lithium ETFs which are listed in the US, and I'll look at both of them. The sector generally is still struggling. It's still below declining moving averages. So even with CXO doing its own thing and quickly trading higher, there could be an individual play going on, but it's not traveling with the broad stream of the sector, which remains in a downward trending environment. So that would probably be cause for extra caution with going into it. There's nothing wrong with taking a trade and having a stop on it, but the more we can get moving in our favour, probably the better the setup. So yeah, look, it's nothing wrong with having a go, I don't think, Rog, and managing your risk around it. But then, like, looking at these other factors as well and working out, look, how much do I want to risk on this? And nothing's ever black or white. There's always different possibilities and ways of looking at things.
Exactly. Actually, that will lead us to our next point around position sizing. We've got a question here from Max, and let's talk about this a little bit at the moment, because I think it's also relevant with the fact that you're saying, all right, we're bullish again, but maybe we're not going all in, right? So we can talk a little bit about position sizing now. his question is basically around, he would generally buy companies around about $10,000 worth of any company, but he only allows him to buy a few companies. He's also found that some of his past sell trades that were a few buy orders at that size at one price. So I had to spread my sale over two or more prices. This surprised me at the time because I thought the company that I was selling would be more liquid than that, and that was ARB, the company ARB. But I guess the question overall, and he was asking me this as well, and to be honest, Max, I'm using Jason's position sizing. For me, let's say as a hypothetical, I'll tell you exactly how much I'm using, but as a hypothetical, if I had $100,000 in an account, it would be 10%. If I had $10,000, it would be 10%, so that would be $1,000, right? So, and as that cash went up or down, so obviously when you sell, that the amount of cash in your account doesn't equal an equal amount. So I'm not just putting $1,000 every time. If it was a $10,000 account, it will be always 10% of that cash balance in the next stock that I was ready to get into. Jace, is that similar to what you do?
Yeah, they're different ways to do position sizing, and I do it differently myself. So in my personal motion trader portfolio, I'm using I'm using 1.25% of capital per stock. So that works out that I can have 80 stocks up to 80 stocks in the portfolio. And the thing I like about using a percentage is as the amount of capital over time hopefully rises, there's that natural built-in way to increase your position size just through the percentage of a larger capital base. And then when the market goes through a bad patch and starts to decline and you get a drawdown in your capital, your investment size comes down with it. So it's constantly adjusting to your position size or to your portfolio, to your capital balance. Then I've got other portfolios where I'm more discretionary in how I place the capital. So I don't think we have to be all one way or the other, but what I'm always doing, I'm always looking at things from a risk reward perspective, and I'm making sure my risk is acceptable, that I'm okay with the downside, that I have a get out point where I say, look, this is not working. I might say I'm prepared to, just maybe I'm prepared to risk, 5 or 10 or whatever it might be on the trade, but then I've got that exit point where I say, okay, enough's enough, I'm out. Rather than a lot of people, they'll go into stocks, they'll buy it thinking, look, I might double my money in this 5-cent stock, but they don't think, well, what could happen if it goes to 2 cents or 1 cent or whatever it may be? Then they don't have the downside covered. So you've got to think about your downside. And also, like, I think the other thing with position sizing, understanding that, like, the more concentrated your portfolio, so some people like to go in and have a 5-stock portfolio or a 10-stock portfolio, and there is some diversification there, but it is highly concentrated. So if you've got a 5-stock portfolio and one stock announces one day that something, they've missed profit guidance and the stock falls 50%, well, losing 50% in one stock in a 5-stock portfolio is going to cause considerable portfolio volatility. Whereas if you've got a 20-stock portfolio and one stock drops 50% overnight, it's not such an overall impact on the portfolio. So just think about how concentrated your portfolio is. I'm hearing this from people with gold stocks at the moment. They've been riding this great wave in the gold price, been doing really well, and they've found their portfolios have been underperforming over the last 4 weeks. And of course, that coincides with the gold price pulling back over the last 4 weeks. So it's great to be concentrated when it's going your way. It's not so fun to be concentrated when things go against you. So we've always got to be thinking, well, am I okay if this starts to go the other way? The same thing applies with leverage. Too much leverage is like, when things are going up, you feel you've never got enough, but when things are going down and you're leveraged, it's like, well, I've got way too much. So think about position sizing from those various perspectives.
And the other question I have, Jason, would it be like for me? Maybe you can manage 80 stocks. For me, it would be too much. I sort of want to think about how many stocks I do want to manage and be able to rotate. And at this point, with my capital, it's 10. Is that a question you would consider, or?
Look, people hear 80 stocks and they think that's just so much. It's like a professional fund manager, but it's just so not the case. It's like I could go several weeks without placing a trade or selling a stock or doing anything. It can be more active as well. If like in a market aggressive market sell off, I can get quite busy trying to unload stocks which are hitting stop losses. But for the most part, and also remember that like the approach I'm using that I talk about all the time, it's medium term. So I'm looking for stocks that could go well over 1 to 3 years. So if I'm holding 80 stocks and I'm a swing trader and I'm looking for gains over the next 3 weeks, it's 80 is going to keep you super busy. But if it's sort of like an active investing approach where you're buying something, if it works, great, keep it. You don't need to do anything. It's low maintenance. So don't need to update anything because the stock's above its exit point and it's just doing what it does. I'm collecting the dividends, they come automatically into the account. A lot of the accounting software now will automatically update the dividends, so you don't need to go through and manually input all the dividend information. So it's good technology we can use now as well, which makes it a lot more manageable. If I was back in the old days, if I was using an Excel spreadsheet trying to record everything, I couldn't do it. It'd just be a nightmare. But the portfolio management / accounting software which is available now makes it so much simpler to do. So I think don't be afraid of having a larger portfolio. It doesn't have to be 80, maybe it's 40 stocks, maybe it's 30 stocks, but I think we can be fairly comfortable going beyond, say, 10 stocks because it's entirely manageable, depending on your process and what you're trying to achieve and everything, of course, and knowing that you can get busy periods where you got to sell it. You get a GFC or a COVID crash, and there's going to be times where it can get busy and even a bit stressful trying to unload everything. But they come along every maybe 5 or 10 years on a week-to-week basis. If you got the right setup with your accounting software and such, it's entirely doable.
All right, that'll be my goal now, 20 stock portfolio. The next question I have for you, Jace, as you were saying, we're bullish, but we're sort of cautiously still bullish being at the top of the market. Are you allocating, you said 1.25% from what I remember. Are you allocating that full 1.25? Are you being a little bit more cautious?
No, I've actually been a little bit cautious on it. So it's I don't know what it is. Maybe I've just rounded it down a bit. Maybe it's about 1% now. Like from a systematic perspective, it just should be 1.25% and that's it. But I can't help but be a little bit discretionary in some aspects. I try to be as least discretionary as possible with my rules-based approach because the best outcomes come when I just follow the rules and don't vary them. But I can't help but just be just a little bit conservative with approaching risk at the moment. And if the market runs hard and I make a little bit less, so be it. I'm just a little bit more comfortable doing it. I think what's important is you can follow your process to a high percentage. So if I can get 90% of it or 95% of it, I'm following. If I'm just paring down a little bit of risk here or there, I think that's okay. It's when you're kind of following your process, maybe 25% of it. It's just you don't really have a process then. Yeah.
Okay, fantastic. All right, some good answers there. I hope that answered your questions, Max. Let's get on some tickets because all of a sudden they've come to us here quite thick and fast. We'll go through 2 of everyone's, and if we have time, we'll circle back and go through the rest. Right. So let's go to start and have a look at silver, please, Jace.
Silver, that has been interesting. Now, I've been discussing this in my weekly strategy session over the last 3 weeks. So if you're not part of my strategy session that goes full time, you probably should come across because we looked at this and called this in advance. Don't get lots of things I don't get right, but this was one which has gone nicely. So yeah, I've been talking about it since it was just coiling up here along the 50-day moving average. And so I've got a position in an ASX silver ETF. I think the ticker code is EPTMAG, I think is the code. Let me just see, ETPMAG. Yeah, there it is there. So it's an ASX silver listed ETF. So it's been coiling up. And so it's been in a range. So just stepping back further. So it's been in this broader range since October last year. And then we kind of had another range developing within the range where prices had rallied strongly off the April low, pulled back. So the signs were the dip was being bought back at the moving average and it's consolidated within another range. And then I've bought a position, it's broken up, then it's broken higher again, and now it's run. So where it goes from here, well, I'm long and I'm happy just to go along for the ride and see what happens. I'm not sure I'd want to buy it at this point now because now it has become stretched above the moving averages. And when that happens, there's a tendency for it to pull back towards the averages. And you can see previous periods where it's run and it's pulled back towards the averages. It runs hard, then it pulls back towards the averages. So it could run further, but then at some point it's going to come back to this 50-day moving average. So from a risk reward perspective, I'm not sure this is an entry point. If I wasn't long and I wanted to get long, I'd be waiting for the next pullback, seeing what it looks like. See if there's that sign that the dips are being bought. But if already in it, I'd be, as I am, it'd be wide trailing stop. My cutout point would be kind of pretty much where I got in. So I'd risk giving back all that gain, getting out at evens or maybe even a touch below, but just see where it goes. It's the big trends where I make my money, not the short breakouts. So yeah, hopefully we get a consolidation and further strength as the weeks and months go on.
Did you mention ETP Mag? Might as well have a quick look at that if that tracks silver. Sydney's asking for it.
Well, that's the one I was just talking about a moment ago. It's I prefer to just look at the silver price because it only trades during ASX hours, and silver makes most of its moves outside of ASX hours. So that's why it's so gappy when you look at it. You just see it's just like gaps everywhere because the move happens overnight, and then ASX opens and you have catch up. So it's in. I guess it's priced in Aussie dollars, so it gives you a truer indication of where it is in local currency terms. But it's the same overall structure we're seeing. So there's silver on the ETF, and then we kick over to the silver price. It's the same broad structure, but you can see there's a lot more depth to the price action. That's why I'm doing that. If you want to see what silver looks like in Aussie dollars, just get this is a CFD on silver, but it's trading nearly 24 hours. You can just change the currency. So I can just change this over to Aussie dollars, and now that will pretty much overlay what that EPTMAG ETF is like. Now looking at silver in Aussie rather than US. I think you just get a better chart overall rather than looking at that ETF where the trading does look looks patchier. But look, that's the instrument I'm using to be long silver, and there's liquidity there. It's an ETF, so there's stuff on the bid and the offer worth considering if you like silver. It was interesting. I was looking at the silver stocks. So this is a couple of weeks ago. Maybe things changed, but the silver stocks nothing was really standing out, both ASX or US listed. It was the action seemed to be, or the setup seemed to be in the silver, the metal rather than the silver stocks. I had to go through and have another look at them, see whether anything started to develop. But and that was the case with gold for a while. All the action was in the gold price, not as much the stocks, although a lot of stocks have done well over the last year or so. But yeah, interesting place, silver. Platinum, palladium, copper, they're all got signs of, particularly platinum and palladium are coming out of lengthy basing periods. and look interesting. Not so many ways to play them on the ASX. There's ETFs where you can play the metals. Not so many stocks exposed to them with like a high exposure to them. You've got to go elsewhere for those.
Yeah, well, we've got a few questions around. I don't know if there's some stocks in there that mine those, but there's definitely a few questions in there around those precious metals. Let's get on to MEI. MEI. I'm not sure if this is one of them. MEI.
MEI meteoric. I think that's more gold orientated, although I'm not sure. Yeah, well, look, this has gone from below to above the moving averages. This is kind of what we were talking about with CXO, where I want to see it go from below to above, and then I want to see what the next consolidation looks like. So there we go. We've got the consolidation. It looks corrective back to the moving averages. Now it's starting to rally off there. I think this is a setup with potential. Just looking at the latest price actions, like the lows are generally getting higher. I think this is sort of like, you can't discount that it's going to consolidate some more. It does like do some more sort of like chopping below the high within a range. But ultimately, at this point, I'd be looking at this as a stock which with breakout potential to the upside. So it could probably be bought at. Let me just measure some risk up. Say it was bought at current levels, like it's a pretty, like maybe you could use that low point from May. It's like it's probably looking at like a 35% stop on it. This is a thing with these lower price stocks. You've got to have those, often need wider stops just because the percentages are greater when they move around. Yeah, look, buying at current levels, I think it probably requires a 35% stop. I think from a risk reward perspective, it probably still stacks up. It's one of those stocks which has the potential to double. Could it trade 13 cents? Could it trade to 26 cents? Absolutely, it could. I don't know that it will, but it certainly could. So risk 35% to potentially make 100%. It's about 3 to 1. It's within the bounds of something which could be considered. Alternatively, see if there's some more consolidation, and then maybe buy a break above the high at what it's about 13.5, 14 cents. So yeah, interesting one to keep an eye on.
All right. All right. Let's get on Jagjeet. Thanks for letting me know about the link. I'll get to my team around that one, Jagjeet. But let's have a look at APA, please. Jagjeet. It looks like you all found it, by the way. If you ever need to find our show because the link's not working, you just go to the Selfwealth by Saif YouTube channel and you can see it'll be there live as the only show running live at 12 o'clock midday.
Okay, so APA, yeah, look, there's the makings of an uptrend here. So I've gone from below to above the averages. The averages have crossed. They're trending high. The price has been moving higher. It's just coming back to the moving averages now to consolidate. If I was in this, I'd be happy to stay in this with the wide trailing stop. If I wasn't in it and I was interested in it, I'd probably just wait and see what this consolidation, how it plays out. Like, do we get a bit of a sideways move along the moving averages and then maybe buy the rally off the moving averages? There's always a possibility that the rally fails and it comes back to the moving averages and keeps working its way lower. So that's why I say this. I probably wouldn't rush to buy it today because it could like start to unwind. So that's why I'd rather just watch, see if it does stabilize around the moving averages, and then if it has stabilized for a couple of weeks, I could probably consider buying the dip then, or buying the breakout. But yeah, I'd certainly be happy to hang on to it.
Nice one. That's RSG's his next one.
Yeah, it's so this is a gold stock, and it's underperformed underperformed the gold sector. There was news around the company. I can't remember what it was, but I think they got an African-based mine. There was trouble around that. Look, if I had this, if I'd recently bought it, if I'd bought it since it's bottomed out and gotten back above the moving averages, I'd be happy to hang on and see where it goes and have my stop loss on it. If I was looking at buying a gold stock, this probably wouldn't be the one I was looking at, because it just has there's been political uncertainty around it, and it's lagging. It's lagging the gold sector. I'd rather be in strong gold stocks rather than battlers which are trying to play catch up. But at this point in time, if I'd bought on that recent swing above the moving averages, there's no reason that it can't continue to grind higher. Stop loss as always, but in terms of buying, I'd probably look elsewhere.
Okay. I reckon we'll go through a few more of these mining stocks by the end of the day anyway. So, but let's have a look at AMI, please. Another one anyway.
Yeah, uptrend. Uptrend is nicely in place. Yeah, look, this is just. I'm probably not a buyer at the moment. Just a little bit of a pullback. Maybe I just watch it, see if we get a bit of a sideways consolidation like we did during May. But if I'm in this one, I'm very happy staying in it. Trailing stops back below the 100-day moving average. See where it goes. Some of these stocks can go a long way. Others don't go too far. They get some modest gains and then come back, and that's okay. You give a few of those back, but you only need to get on one or two that go a long way. It can really make a big difference to the portfolio. So I'd be hanging on and seeing if it turns into one of those outliers which go a long way. But always have that risk point in mind where you say, okay, enough's enough, I'm getting out, and not just holding and hoping forevermore. Like, you don't want to get stuck in these situations where something seems to be doing nicely, but then the situation reverses. So always have that get out point, so you don't overstay your time in a stock when it starts to deteriorate. But that's not the case here. This is a stock I'd be happy to continue holding.
Just a beautiful name as well, Aurelia. If I tell you now, a bit of a useless fact here, Jason. If I ever had a girl, which I won't anymore, but that would have been the name of the girl that I was going to have, Aurelia. Probably not Metals, but Aurelia. All right, let's have a look at James. That was Alan's. Let's have a look at James. He wants to look at the platinum chart.
Platinum, okay. Platinum, we've got that here. There's palladium, there's platinum. So big base, this big basing structure. Let's just pop it on a weekly for a moment. So, look where it's come from. It's been such a down and out metal. Is this finally its time? Is this like a basing structure? It's certainly got that potential. There's certainly plenty of upside. You look at where it's come. Why can't it get back to its all-time high from 2008? I'm not saying that's going to happen anytime soon, but at some point in the course of time, why not? I think. I'm just going to pop back onto a daily. Yeah, where it's breaking out. Depends how you want to draw this. You could draw a line across there and say, just roughly, these aren't rock solid lines. I'm missing points and stuff. But generally, you can see it's coiled up within those bounds, and it's now out of there. So I think, if I had exposure to platinum, I'd be very happy staying that way. If I'm looking to get into it now, well, now I've got to wait for the next pullback because it's so stretched now above the moving averages. I'd expect that at some point it's going to have that pause and pullback. You look at this initial move. So you look at this and you see how prices got stretched above the moving averages, and they do come back. Prices come back when they rally. They can rally hard, but they do come back to the averages. You find lots of examples when you go along. It rallies hard, comes back to the averages. So that's what I'd be looking for now with this. I'd be looking for the next consolidation as a possible entry point. But if long, just staying long and seeing whether this is the start of a big rally. I don't want to try and bank a small profit, going, oh wow, I'm up I've quickly made 10% or whatever it may be. I'm not bothered by 10%. I want to make 100% or more. So if I'm in, I'm staying in. I'm risking giving back what I've made for the chance of much bigger potential gain.
Yeah. Actually, I'm loving this conversation around these precious metals, to be honest, because it does allow people to formulate ideas and get prepared for a bigger move with them. Because obviously gold has done its run, and maybe it is now time for the other metals to start catching up. Obviously, we're talking about sentiment. It might not. It might go completely the opposite way. They might all dump and go the opposite way tomorrow, right? We don't know. But it's good having this conversation, being prepared and ready around some of these precious metals who seem to have moved a little bit over the last few days, right?
Like, that's interesting. So there's palladium. We're getting the same sort of uplift in palladium. If you want a leveraged way to play it, there's this US-based stock, SBSW. That's one way to play it. You can see it's skyrocketed. I don't have any. I've watched it for ages. I was kind of half looking at it when it was consolidating above the moving averages, and it went quickly, and I wasn't paying attention. It's gotten away a bit now, but that's a leverage play for those platinum palladium group type metals. Then you look at something like nickel. Nickel's not participating. It's still got those declining moving averages, and lithium is in the same basket as nickel. But then we've got silver, which is breaking out, copper, which is like been on moving averages and looks like it wants to test higher, and gold, which looks like it still wants to. It's in this sideways range at the moment. Does it get? We could, maybe there's more consolidation coming, but it's but it has been a really strong one. It's something I talk about in the weekly strategy sessions. I won't go on and on about gold now. But you can see there's a mix going on with these metals: platinum, palladium, and silver, and maybe copper. On the plus side, gold's had a big performance, and then you've got nickel and lithium, which are just not playing, and oil, which hasn't been doing much either. So it's a real mix with those commodities. What's going on? So I think it's a fascinating to just watch it all, see what's unfolding, and trying to work it out and where the plays are.
Yep. All right. So the next one is from Shirley. Let's have a look at MPL, please.
Uptrend. Happy to stay long. No reason to do anything with that. This is why we use the wide trailing stops. Yeah, there's the volatility from the tariff sell-off. Just came back to the 50-day moving average. You'd be pretty upset if you were in this one and you got scared out on this pullback. Just back to the 50-day. Wide trailing stop would have easily seen that off and kept you on board. I'm probably not technically it could be a buy here. It's having a little bit of a sideways consolidation. The moving averages are catching up. Buying here it's going with the trend, and who's to say how much? Nothing to say the trend can't go a whole lot higher. It's just not the sort of entry I prefer. I prefer it when they're like rallying off the moving averages, or they're breaking out of ranges. It's just my preference for an entry setup. But in terms of like trading with something which is rising, it meets that criteria. I'd certainly be holding if I was in it.
All right, Qantas.
Yeah, same here. Trend still in place. Yeah, trends in place. Happy holding onto Qantas. Wide trailing stop may have seen off this pullback. I'm not sure. It's 27%, which is depending on the volatility of the stock, and how the ATR trailing stop works. That may or may not have been a survivable pullback. It's close to it, but presuming someone's seen that off, they're still in it. I'd be staying in it. Probably not a buyer at current levels, just because it's had that big move from below the averages to above. I think at some point, maybe not too far off, we do get some consolidation while the averages catch up.
Okay. All right. The next one's from Steve, which is BTR.
Yeah, I think we looked at this last week. Like it was a bit stretched, and now it's come back. But it's come like I don't really like the way it's come back, in that it doesn't look like the dip's being too keenly bought. And this is like kind of saw something similar in October. So it had a strong rally, but then when it came back, it just came back with a thud. Um, it probably really need to hold the line around current levels. There's probably I'm just seeing there's probably some support. Like you're looking at these highs, 49 and a half. There's some activity. You can see some technical activity through this area generally. I'd probably really want to see it holding the line at current levels. I wouldn't be a buyer at this point. I'd want to see it stabilise. Like for me to get interested in this stock, I'd need to see it stabilise and then start to lift off the moving averages. So there's a bit of work to do before it can stabilise. It's certainly, if I was in this, particularly if I was in from better levels earlier on, that's okay. I'd be happy to hold in there with a wide stop. But if I was a recent buyer, that's where I'd be like going, okay, I've got to have my exit point in mind, and I wouldn't be stepping up to buy at the moment.
Mm-hmm. All right, Kirby's next with GHY, please.
Well, it's gotten itself back above the averages, and the averages are trying to cross, but it's like it is slipping losing a little bit of footing just in the last week. Ideally it would you get that sideways move above the averages and another breakout, but it's just that little bit of slippage in the last week. Ideally, it'll hold the low from last Monday. Breaks below last Monday's low, then it really does open up the risk that it continues just to slide back down towards the March low. But look, if it can hold the line here around the moving averages, we could still see this kick up. I don't have a strong feel on this one because we don't have an established trend. It's just is this a turnaround taking place? And sometimes these turnarounds work, and sometimes they start to turn, but then they just lose the momentum and they slide. So if I was in this one, I'd certainly be having my exit point in mind, where I say, look, enough's enough. I'll just walk away for now. I can always come back later, but I'll protect my capital. And if I was interested in getting in, I think there's time to watch it and just see whether it stabilises, see whether it starts to lift off again.
All right, Doug, DEG.
Yeah, this was a great trending stock. This is a stock I had myself. It was a motion trader stock. Entry was back in early 23. Rode a lovely trend with only a few pullbacks to the 100-day moving average. And then it peaked and the trailing stop triggered. And I've been out of this stock for, I don't know, 7 or 8 months maybe. And haven't looked at it for a while. And it's interesting to look at it now. And it's just continued to unravel below the moving averages. That's why we use trailing stops. So you don't have the frustration of riding it all the way up and then all the way back down. But what happens here? So is there a turn in the making? There could be, but it's a little bit too early for me at the moment. Had this initial rally to the 100-day average, it's pulled back, it's rallied again. The average is starting to turn. So there could be something in the makings here, but you could also say, look, is that a head and shoulders? You got a shoulder, a head, and a shoulder, little technical formation. So there's some signs there could be like a turning point in the makings. I'd probably like to see a little bit more consolidation. I'd like to see that. This is like one of my favourite setups, where you get a rally, then you get sideways while the moving averages come up underneath, and then you get the break. Move that along. Yeah, that's sort of like where I'd get interested. So there's a bit more price action required to possibly get to that sort of setup, but that setup mightn't even occur. It's just like one of those classic setups I look for. Doesn't mean we're going to get it in this instance. So for now, I'd just watch this one for now with an upward bias, but I probably wouldn't act on it just yet. I want a little bit more of a setup and play. But yeah, it's certainly an interesting one to keep an eye on.
All right, fantastic. Jennifer wants us, since coming off the back of your thoughts around uranium last week, she wants us to look at uranium, another commodity, obviously.
Of course. Didn't think mentioning that earlier, but yeah, look, I talk about this in the strategy session each week, and we've talked about some stocks recently. It's gone from below the averages to above. We're now getting that consolidation along the averages, and the averages are turning higher. So it's looking maybe uranium's made a low. Maybe there's a play here in the uranium price. Yeah, it's certainly got the potentials of going higher from here. It's gone from being in a vulnerable position to now being in a position for a notable turnaround. So I bought a uranium stock a couple of weeks ago. I'm looking at them every day for the signals to add to that position, and see whether this turnaround can really get a good footing. It may not. We could also, like, the other thing to remember is like look at this consolidation from 2022, 23. So we had these rallies from below the moving averages to above, but then it would come back down and then up, and it would oscillate either side. So there's nothing to say we're not going to see something similar develop over months now. That could still play out, even though it's gone from below to above the averages. We still could get a lengthy sideways consolidation. So for me, it's a case of getting a starter position, seeing whether this can hold it, can stabilize above the averages and kick again. If it does, great. I've got a position, I can get some more. But if it stalls out and starts to come back below, and the whole sector just starts moving sideways, well, then I can just get out of the sector again, go do other things, just put it to the side and wait for a breakout whenever that may happen. Just got to wait these things out. We never know. We never know when the actual turn's going to happen until we look back and in hindsight. But we can see the makings of one. Let's just see whether this one continues to build into a lasting turn.
All right. Next one's from D Shiz. BRN, please.
Look, it's such a volatile stock, this one. Look, it's not one I'd consider at the moment because it's got the declining moving averages. You could say there's had a strong rally from above to below, and now it's sold off, but it's stabilised. It's stabilised and it's tracking sideways. So, could this be a platform for another push higher? It certainly could be, but I'm just not enthusiastic about it because it gives us so many false starts in this stock. Now, it's interesting because people often say, look, this stock's let me down in the past, I don't want to know about it. So we shouldn't be biased against a stock because it has had false starts and say, look, I don't trade this one because it just gives false starts. At some point, it could go. One of these starts could actually like lift off. But I wouldn't be chasing it at this point. I'd probably want to see. Break out. Like if it can go sideways and then break out, like buy into a breakout would probably be the way I'd want to play it. Not as it just sort of like grinds below the moving averages.
Yeah, CHN.
Well, this has been one of those ones people have been looking for the low end for quite a long time. Maybe, but is this different to what we saw in January, March? where it went from below to above the averages and then came back down below. You saw something last year from below to above, had a bit of a run, then came back down below. So, and then similar from earlier in 24. Like something could develop here, but I'm probably not rushing into this one. Averages are starting to turn higher. It's one of those ones I'd keep an eye on. And if we got that sideways consolidation while the moving averages turn, then possibly buy it in a few weeks if we get that sideways trading, or buy a breakout out of a range if that occurs. So there's not enough of a setup for me at the moment, other than just sort of like buying. And what was your saying from earlier in the show, Roger? Was a hit and hope or something?
Yeah, it was my hit and hope portfolio. Yeah.
Hit and hope. So this would be a bit of a hit and hoper at the moment. It's something could develop here, and you can manage risk around it. You could say, look, in at current levels, and I put a stop below that recent low. It's still 25%. So 25% for a hit and hope. Like a hit and hope, might be if you can do 10 or 15%. But I don't think you could do a 10 or 15% here with a reasonable prospect of staying in, because you could get a 10% pullback and it's just noise, and then it's higher the next day. So yeah, it's a hit and hope prospect, but I probably don't do too many hit and hopes. I probably prefer to get that better structure and manage risk around that.
Mind you, I should just once again, general advice only as usual, right? My hit and hope portfolio I've run well before the motion trader version of my trading and investing, and now I'm actually trying to fill, because it's quite a fair way down compared to my motion trader, which is quite a fair way up. It's the opposite, so they're kind of hedging each other off a little bit. But I'm actually trying to refill my hit and hope portfolio with motion trader style stocks, right? With trending stocks. So I think we need to look at the trend is your friend more as a philosophy, Jason, than hit and hope, right? So
yeah, I think like if some like I think there'd be a lot of people who do hit and hope would be open ended. It's like hit, and I'm just going to hope forevermore that this comes good sometime. I I think that's probably my least favourite way to go forward. So if I want to hit, I want to hope it goes up before it gets to a predetermined exit point, and there I can cut it, and I can go in saying, look, I can see a pathway for this stock, but I'm only going to give it 20% or 25%, and then I'm out. Rather than just, okay, well, now it's down 30%, so maybe I'll average down into it. That's when the wheels just come off quite often for a lot of people. So yeah, I don't think it's. I think going with momentum, buying breakouts, buying rallies off moving averages, buying dips to rising moving averages, I think these are all good ways to consider going forward. And if you do want to play hit and hope, that's okay. But I think have a predetermined exit point. Say, okay, this is how much I'm prepared to risk, how much I'm prepared to lose, and okay, that's okay. But it's just when you have these open-ended losses, which that's when people they almost never get ahead.
exactly. Well, look, I mean, obviously, the way you said it then, if you have a hit hope, I'm a different trader and different investor these days. So I've always got a predetermined exit level at that point, based on my risk level of that portfolio, right? So, and if you want to obviously learn about Kirby's risks, way of learning risk, there's a good little paragraph there from Kirby. So have a read of that there as well. But let's get back onto the stocks, right? MIN, because as we wrap up, coming close to the end of the show, we need to get through these stocks.
Still in a downtrend, declining moving averages. It's rallied back to the 100-day, but the downtrend's in force. It could have bottomed here. It could, but we could have said the same thing at many other points over the past year or so. I just leave this alone. Let's wait until it's back above rising moving averages. That's probably still a bit off. Nothing wrong with watching it, but preempting the turn has been an expensive exercise for a lot of people. So, let's not jump on the bandwagon of what hasn't been working. That's been trying to pick the low on this stock. One day the low may well, we look at it and it could well be the low, but the odds continue to favour that the prevailing direction of the trend, which remains down.
Yeah. All right. PLS.
Ditto with this, exactly the same. This looks even worse in that, like with that previous stock, yeah, you could say its recent low was above the prior low. This one here has just made a new low, so the trend is very much in the to the downside at the moment, declining moving averages. I'd just leave it alone. Why is this point, which this low, which from this month, why is that any different to the low from December? It's like, or the low from March. Like, what makes these points different when you look at them? There's, to me, they're indistinguishable. Doesn't mean that this can't be the final low, but I think the odds favour that it plays out like these previous occasions where it's you get a rally back to the averages, which gets sold again. So I just if it's in a tailspin, walk away and watch it from afar. Don't I think twice before getting involved.
Okay, thank you, Sydney, and thank you, Jace, for those two. Let's have a look at K's, which is RGTI.
US stock, I think. Yeah, well, all the since this this massive rally, all the consolidation's been around the moving averages, so that's positive. There's been that interest in buying this stock on the way down. It's when they go up and they come straight back down that there's not much to see. But this one's come, it's had a huge pullback, but it's holding around those moving averages. If I was in this, particularly if I was in it from lower levels, I'd be happy hanging on to it. Like even a wide trailing. Be interesting. Let's just put a wide trailing stop on and see whether it works for this one because it's so volatile. Just going to have to adjust this back. Yeah, well, like when you do an ATR based calculated trailing stop, you can see how wide the stop is, but it has stayed in the stock. It saw off a very large pullback, and that's because the ranges are so wide. When you do a multiple of wide ranges, you tend to get a very big stop. So look, if I was in this from lower levels, I'd be happy to stay in it. If it to consider like an entry point or adding to it, I'd probably want to see it like stabilize above the 50-day average. Like, again, maybe we get this sort of price action where just get a bit of stability along the averages and then a break high from there. That'd be an entry point for me. Let's see how this one goes. It's certainly got the makings of further upward momentum.
Nice. Rodney says EML.
There's an uptrend there. It's it's recently broken out of a range. You can see I just mark up the range quickly. It's like coiled up in there. We've got a breakout. So I've only recently had a breakout. So I guess it's one of those ones which it could be considered at current levels with a stop back inside the range. It's probably about like an 18% stop probably, or maybe a touch more, maybe a 20% stop. Alternatively, just see whether we get that maybe the pullback towards the breakout point and then another rally developing. So maybe it could be like, buy a dip just back towards this breakout point, or buy a breakout. If we get a sideways movement, buy a breakout from the sideways movement. So a couple of different ways that could be played, or it could just be a matter of just already being positioned and holding on. But makings of further upside there. Rising lows, which is encouraging. Making new highs. Stock to consider.
Nice one. All right, next one is silvers, which is PPM.
BPN?
PPM. Double P.
So what is it, Rog?
Double PM.
Well, yeah, there's some makings of something here. It's like it's gone through this ranging period. It's broken higher. I like how you had that initial rally, then you got that consolidation, sideways consolidation back towards the moving averages, and another rally. That said, it has come back pretty abruptly today. If I was in it, like if I'd bought this early breakout, sure, I'd stay in this and see where it goes. If I wasn't in it, I probably wouldn't buy it at the moment. Just with I don't like that sharp pullback. I'd now want to see it stabilise, let these moving averages catch up. It's a bit of a messy sort of stock, but it's certainly possible. Like this period from 22 through to current day, like it's certainly possible. This is like just like a large basing period and starting to lift out from it. So it's stock to keep an eye on. Like as I say, if we bought the initial break, great. Let's see where it goes. If not, just see how this pullback plays out and consider an entry point if the price action justifies. But yeah, worth keeping an eye on.
All right. WDS over the long term, looking for the long term.
Well, this is where like we've got to distinguish between long-term buy and hold and active investing. So from an active investing standpoint, this has been trending lower for too long. So I would have moved on. But then if we're like a long-term investor, well, it's another matter altogether. It's long-term investors aren't active investors; they just tend to buy and hold. There's nothing fundamentally wrong with that. Just as long as you're, I think even if you're a long-term buy and hold, let's not even go there. It's just a very different proposition. So from an active investing standpoint, look, I'd be out of Woodside. Like 18 months below declining moving averages isn't a play for me. Is it turning higher at the moment? We've had a few occasions where it looked like it could have been starting to turn, but it hasn't. I'd continue to stay out of it. The oil price is sort of like delicately poised. Where is it struggling to sell off any further, or is it just holding in there and about to get sold again? So I don't know which way that goes. Woodside probably moves generally along with the oil sector generally. Yeah. So I won't talk about the long term because it's not the way I play it. But from my active investing standpoint, it's still not where I want to be.
Yeah. All right. We'll just circle back. There's a couple more we'll have a bit of time for now. So let's go to EL8, please.
Yeah, super interesting. Look at this. So from below to above, zigzag correction back to the moving averages, going sideways along the moving averages. So what is the play here? It's this is probably chart of the day for setups. So it doesn't mean now. Let me just say, when I say that, it doesn't mean that this is going to rocket higher, but just means it's got the cleanest setup and nice parameters around being able to manage it. It could still fail. Lots of great setups fail. Nonetheless, with this one here, like say a position was bought now. So if we want to say, look, we think the uranium price is going to continue turning higher, or we want to even if we're not sure, but we think it could move higher, we could buy a stock we could buy this at current levels and put a stop loss, say maybe 15%. 15 to 16% lower. So it's just going below this low point from May. So we're going on a zigzag correction to the May low. So if the May low holds, it could then be set up for another rally. So that's why I think it needs at least about 16%. So if it doesn't work, fine, lose 16%. But if it does work, it's one of those stocks which could double. like just getting back to where it was 18 months ago. It's one of those stocks that could double. So it's asymmetric in that we can risk, say, 16% to make possibly 100% or more, or maybe less. But it's got that upside potential. So clear levels to play. Alternatively, it's about buying a breakout maybe above. Could possibly use the May 26 high. So prices break above the May 26 high. So basically, they start to break above this this downward trend line. So you get a rally from current levels. Something like up to here, get a strong day, say, fine, I'm going to go with that momentum. And then I can say, look, I can buy that. I can have a stop below this back at the moving averages. Maybe it's about 21% then. But yeah, you can see how there's a setup there, and the risk reward is skewed, and we're using a commodity, which uranium, which looks like it could be turning higher. Doesn't mean it will, but it's everything's moving in the right direction. So unlike when we looked at CXO at the start of the show, like a lithium stock, which maybe it was starting to break higher, but then the lithium tide generally was still negative when we looked at those lithium ETFs. In this one here, we're looking at a stock which has a nice setup, and then we're contrasting that with we're comparing it to the underlying commodity, which also has a setup which is above moving averages, which could support higher prices. So there's more of a tidal shift in its favour. Again, it doesn't mean it's going to work out. So no one should go out and buy EL8, which is at the speculative end of the uranium universe, expecting it's going to work out and they're going to make money, because often we lose money in these situations that even look good. But the key is don't lose too much, but then when we're right, hopefully make a whole lot.
Yeah. All right. We'll finish off with REG, please, Jace.
Uptrend still in place. Pull back to the 50-day moving average. If I had it, I'd be holding it. Wide trailing stop. Nothing's changed there. It's come out of this sideways range recently. So that was another entry point when it broke from the range. If you want to buy dips, this qualifies as buying at the dip. It's buying a stock which is in an uptrend, pulling back to a 50-day moving average, like sort of like the price action we've seen in the past, where it's pulled back to the 50-day moving average. Sometimes it'll pull back and can overshoot. But if you want to buy the dip, it's these pullbacks to the moving averages where they're the sort of dips I want to buy. I don't want to buy these dips when price is declining below the moving averages. That's when we walk away. It's certainly a hold of if I had it. As I've just been saying, for those who want to buy dips into an upward trend, it does meet that criteria. But of course, then you have an exit point. Go look back below the 100-day moving average. Maybe if I bought now, I'd be risking, I don't know, maybe 15% or something. You've got to work out that exit point to give it reasonable room to move, and then hopefully stay on an ongoing trend.
All right, fantastic. All right, I think we'll wrap it up there, Jace. It's been a quality show where we're talking about various things around position sizing, sentiment that may back up your positions technically, or the other way around, whichever way you want to look at it. I think it's been great learning some of these things once again and reiterating some points that we always talk about, right? Especially around position sizing, because that could mean the big difference between staying in the game for the long term or just or not lasting that long because you've only got a couple of stocks that go completely against you and just give up, right? So I think it's a huge difference in the way I saw things many moons ago. And even people who ask me now, who might only have a small amount of capital or whatever it is, they'll be all in on one stock rather than waiting for the right time and have multiple positions. Anyway, just remember, it's been a great show once again, but everything we say or do is general advice only. Please do your own research. out there. It's a great time to be in the markets, but can also be difficult. So just be wary around your risk parameters once again. We love doing this show each week, so please come on in at any time. Ask your questions. If you want to ask by email, you can ask by email as well. We try and fit in as much as we can in the hour and a half that we do things. Generally under, we try and be under, but and apologies if there's a link that was missed somewhere in one of these emails that's gone out today as well, probably on the Selfwealth side. We'll look at that and hopefully we'll make that right next week. Thanks, Jace.
Thanks, Rog. That's been fun. Thank you, everyone, for joining us. It's been great talking to you. Look forward to coming back and, do another show next week.
Yep, it is. It will be another great show next week. Thanks you, everyone, for coming, and we will chat next week. Take care. Bye-bye.